Lesson 6, Taxes, Ownership, and Beneficiaries. Welcome back. In Lesson 5, we compared the major types of life insurance. Now we need to discuss 3 decisions that can be just as important as the policy itself. Who is insured? Who owns the policy? And who receives the money? These roles may be filled by the same person or by different people. The choices can affect who controls the policy, who may change the beneficiary, how the death benefit is paid, and how the policy may be treated for tax and estate planning purposes. Let's take it one step at a time. A life insurance policy usually involves 4 important roles. The insured is the person whose life is covered. The death benefit becomes payable when the insured dies and the claim meets the policy requirements. The policy owner controls the policy. Depending on the contract, the owner may be able to choose or change beneficiaries, pay the premiums, or even borrow against cash value. The primary beneficiary is the first person or trust in line to receive the death benefit. The contingent beneficiary is the backup. Do not overlook the backup beneficiary. Without one, the proceeds could become payable to the insured's estate. Are death benefits taxable? Generally, federal income tax-free. Proceeds paid because of the insured's death are usually not included in the beneficiary's taxable income. For example, if a beneficiary receives a $500,000 lump sum death benefit, that amount is generally not reported as ordinary income. However, there are exceptions. The rules may be different when a policy was transferred for money or if a business owns the coverage. Interest paid to the beneficiary is generally taxable, even when the death benefit itself is not. That is why we say proceeds are generally income tax-free. Federal income tax and federal estate tax are 2 different issues. A death benefit may still be included in the insured's estate for federal estate tax purposes. Most families will not owe federal estate tax because their estates fall below the filing threshold, but the rules and exemption amounts can change. People with larger estates should review policy ownership with an estate planning attorney and tax professional. Do not change ownership simply to pursue a tax benefit. Permanent life insurance policies may build cash value. That value generally grows without current income tax while it remains inside the policy. But taking money out may create tax and policy consequences. A withdrawal may reduce the cash value, the death benefit, and future policy support. Policy loans are not free money. The insurance company charges interest. An unpaid loan generally reduces the death benefit available to beneficiaries. If a policy lapses with a large outstanding loan, you could face taxable income without receiving cash to pay the tax. Ask for an updated illustration before borrowing. The beneficiary should match the purpose of the policy. Possible beneficiaries may include a spouse, adult children, a trust, or even a charity. Be careful when naming minor children. A life insurance company generally cannot simply hand a large death benefit to a young child. A trust may be a better option. Keep beneficiaries current. A designation normally controls the proceeds even when a will says something different. Review after any major family change. Now turn to the Policy Ownership and Beneficiary Review section of your workbook. Use the actual policy records, not your memory. The policy type matters, but ownership and beneficiary decisions help determine whether the policy works as intended. Review the policy carefully. In Lesson 7, we will look at how life insurance is sold and the role of agents. You are learning how to build protection that works. I'll see you in Lesson 7. Let's build your future together.